All right, let's get right into it. We're going to tackle a really complex and, honestly, a pretty confusing financial issue that affects thousands of veterans. It's this strange intersection where the rules from the DoD, the VA, and the IRS all kind of crash into each other, creating what we can only call a tax paradox. This is all about the money you got to help you transition back to civilian life and how the government can actually force you to pay it back in a way that leaves you with a serious tax problem.
So let me just ask you this straight up. Does this sound familiar? You received your military separation pay, you saw the income tax get taken out, you filed your return, and then, boom, you find out that because you now qualify for VA disability benefits, the government has to, by law, take that separation pay back from you, dollar for dollar. If you're nodding your head right now, then this explainer is absolutely for you.
And this is what we're calling the recoupment paradox. It's such a frustrating loop. See, you get a payment that's taxable, but then you have to repay it using your disability benefits, which are tax-free. So what's happening? A benefit that's supposed to be tax-free is being used to pay back a taxed one. The bottom line is you can end up paying taxes on income you were never actually allowed to keep. It's a real financial injury, and it's written right into the law. But, and this is the important part, there's also a remedy written into the tax code.
Okay, so here's our game plan. We're going to start by unpacking the laws that create this whole mess. Then, we'll break down exactly how this tax injury happens. After that, we'll get to the good stuff, the solution, which is a specific part of the tax code called IRC Section 1341. And finally, we'll walk you through step by step how to figure out your relief and file your claim the right way to get that money back. Let's do this.
First things first, we have to look at the legal foundation of this paradox. I know, it's the legal stuff, but to really get the solution, you've got to understand the laws that create the problem in the first place. This is where it all starts.
So, a few different types of separation pay get caught in this same trap. You've got involuntary separation pay, or ISP. There's the special separation benefit, you might remember that from the drawdown in the 90s, and even disability severance pay. Now, VSI, or Voluntary Separation Incentive, is also on the list, but because it's paid out like an annuity, it usually dodges this specific tax issue. But for the others, yep, they all fall under the exact same legal mandate.
And look, the law itself is crystal clear. This is straight out of Title 10 of the U.S. Code, Section 1174. The two most important words here are shall have deducted. That's not a suggestion, it's a command. It gives the VA zero wiggle room. The whole point of the law is to prevent what Congress considers double dipping, getting two benefits for the same period of service. So if you get set pay and then a VA disability award, the law requires the VA to get that separation pay back.
Okay, now that we see the law in action, let's look at how it creates a direct hit to your wallet. This is where we get into the nitty-gritty of the tax injury itself.
So how big of a tax injury we're talking about really depends on when you got your separation pay. Before September 30th, 1996, the government had this gross recoupment system. So using this example, say you got $50,000 in separation pay and paid $10 grand in federal tax on it. Well, the VA would take back the entire $50,000. Think about that. You're repaying $10,000 you never even saw. Congress realized how unfair that was and changed the law. So for payments after that date, they switched to a net system. Now the VA only takes back the amount after federal income tax was withheld. So in our example, $40,000. It's way better, but notice the fine print? The law only covers federal income tax. It doesn't account for state or FICA taxes, so a smaller tax injury can still happen even under the new rules.
Okay, so this next part is super important for understanding how this all works for tax purposes. You're not actually writing a check to the government, right? Well, the tax law has this concept called Constructive Receipt. Let's say your VA benefit is $3,000 a month, but the VA holds back $1,000 for recoupment. Legally, the IRS sees that as you receiving the full $3 grand, and then you immediately chose to use $1,000 of it to pay down your debt. That constructive repayment is the key. It's the official event that makes you eligible for tax relief.
And that brings us to the solution. Finally, right? After all that setup, here is the good news. There's a specific tool in the Internal Revenue Code designed for this exact scenario. Let's talk about IRC Section 1341. This is your legal tool for tax recovery.
Section 1341 is often called the Claim of Right Doctrine. Its whole purpose is to fix this unfair situation where the tax system kind of traps you. You get income one year, it looks like it's all yours, so you do the right thing and pay tax on it. But then, in a later year, you're forced to give that money back. Section 1341 is what makes sure you can get the tax part of that money back too.
Now, to use it, you have to pass a very specific three-part test. First, when you got the separation pay, it had to look like you had an unrestricted right to it. For SEP pay, check. That's a definite yes. Second, in a later year, it had to be established that you actually did not have that unrestricted right. Your VA disability award does exactly that. Check. And third, the amount you pay back in a single tax year has to be over a certain amount. And that magic number is $3,000. If the total amount of your VA benefit that's withheld for recoupment in one calendar year is more than $3,000, you qualify to use Section 1341. If it's less than that, well, it falls under some different, less helpful rules for itemized deductions, which, by the way, are currently suspended under the Tax Cuts and Jobs Act. So for right now, if you're repaying less than $3,000 a year, you're unfortunately kind of stuck without a federal tax remedy.
You know, for a long time, the IRS actually fought this. They argued that veterans did have an unrestricted right to the money when they got it. But a huge landmark court case, Andrews v. United States, finally settled it. The court basically said no. The right to keep that separation pay was never truly unrestricted. It was always conditional on not getting VA disability benefits later. That court case is what blew the doors wide open for veterans to use Section 1341.
Okay, so you pass the test, your repayment is over $3,000. Now what? How do you actually figure out your tax relief? Well, Section 1341 gives you two choices. You can take it as a deduction, or you can take it as a credit. And the best part is, you get to pick whichever one saves you more money.
Let's break down this chart. The first option is the deduction under Section 1341A4. You just deduct the amount you repaid on this year's tax return. Honestly, this is almost never the best choice. For one, its status under the current tax law is a little shaky, but more importantly, a deduction only saves you tax at your current tax rate. The second option, the credit method, under Section 1341A5, is almost always the clear winner for veterans. What you do here is go back and recalculate the tax for the year you received the separation pay, but you pretend you never got that income. The difference in tax between what you paid then and what you would have paid becomes a credit on your current tax return. And since most of us are in a higher tax bracket in our last year of service than in retirement, this usually means a much bigger refund.
All right, we're in the home stretch. Let's talk about filing your claim correctly. Knowing the law is one thing, but dealing with the actual paperwork is a whole other battle. We'll go over the exact procedure and some common mistakes to avoid.
Okay, this is probably one of the biggest mistakes people make. They confuse two totally different legal arguments. A Section 1341 claim is for recoupment. Your argument is basically, hey, I got this taxable separation pay, and then I was forced to give it back. The action you take is to claim a credit on your current year's tax return. A Strickling claim is different. That's for when the VA makes a retroactive disability decision, which legally changes what that past pay was. The argument there is, whoops, that money was never supposed to be taxable in the first place. And for that, you have to go back and amend your old tax returns with a Form 1040X. They are not the same thing.
Now, when you file your Section 1341 claim, you've got to have your ducks in a row. Here's your checklist. Number 1, your VA award letter. It has to clearly, explicitly show a line item that says recoupment of separation pay. Number 2, a copy of your W-2 from the year you got the separation pay. This proves you included it in your income. And number 3, a simple written statement that you attach to your return, just explaining that you're claiming a credit under IRC 1341 for the mandatory repayment of your military separation pay.
And this is a detail you absolutely cannot mess up. The credit you calculated, it goes on one specific line. Form 1040, Schedule 3, line 13. But here's the critical part. You must write IRC 1341 on the little dotted line right next to the number. That tiny note is a flag for the IRS to process it correctly. If you skip that, you're just asking for an automated rejection letter and months of delays.
Okay, this is a question we get all the time, and it causes a lot of anxiety. A lot of veterans are repaying SEP pay they got 5, 10, even 15 years ago. And those tax years are way past the normal 3-year window for filing an amended return. So, does that mean you're just out of luck?
No, absolutely not. And here's why it's not a problem. A Section 1341 claim is all about the year of repayment, not the year you receive the money. You are filing this claim on your current tax return for the repayments that happened this year. The statute of limitations on that old tax year, it's totally irrelevant. You're only looking back at that old return to calculate how big your credit is. The claim itself is perfectly on time.
So, let's just quickly recap the most important points. First, this whole recoupment paradox thing creates a very real tax injury.
But the good news is, the tax code itself, specifically IRC Section 1341, gives you the legal tool to fix it. When you're figuring out how much you get back, the credit method is almost always your best move. And remember, you make the claim in the year you repay the money. So don't worry about the statute of limitations on the original year. And finally, getting the paperwork and the labeling on the forms exactly right is absolutely critical.
We'll leave you with this final thought. You earned that separation pay. You paid taxes on it. And then, because of a different law, you were forced to pay it back. The system provides a way to make you financially whole on the tax part of that deal. So the only real question left is, are you sure you've claimed the relief that you are legally owed? Thanks for tuning in to this explainer.